Yo, what's up, everyone? My name is Dom, and we're going to talk about unusual options activity. Let's kick it off with the disclaimer. So, disclaimer, this video is for educational purposes only. The statements made in this program are solely the opinion of the show and are not a specific inducement to make an investment. One must perform their own due diligence and realize that all investments carry risk. There's no guarantee of profit. Okay, everyone, first one I want to bring up is UPST, Upstart Holdings. Now, this is a financial artificial intelligence lending platform software that banks use to help analyze their clients and how to pick the right people to loan to. So it saves them a lot of money in customer acquisition, and having artificial intelligence skim through all of the people applying for loans is a heck of a lot easier than somebody at the bank sitting down and actually going through everybody's finances, going through W-2s, going through all that. So I think this is a really powerful platform here. Full disclosure, I have long stock positions in this one. I do not own the options in this one, but there was some interesting activity here expiring tomorrow. They were buying the at-the-money calls at the time, the 133 strike. This stock traded up to about 137 shortly after they bought these calls. But we'll have to see tomorrow morning if they're still in. Now, this is an extremely short-term trade here. They also look to be buying the August 13th one. There's some calls trading here. Now, they have earnings next week, August 10th, I think it is. Now, I really like this stock. I like the company. I like the management team. The valuation is obviously not ideal. It's a growth stock, so it's kind of a little difficult to value here. But this stock has had a pullback from about this 191 level here. I'm in the stock. I'm long the stock. I'm holding it. One thing I will say from owning this stock, the past few months, this thing has some serious resistance here at the 133 to 137 level. But once we break through that, you can see here multiple times it's come up. It's come up here throughout the day because it's a candlestick chart, so it shows the highs and lows here. It comes up and then immediately pulls back. It did the same thing today, coming up to this 137 level. It did it the other day. It did it here. It did it here. It did it here. It did it here. So, but once this thing gets through this 133 to 137 level, I think it is off to the races to 190. I'm not sure if earnings are going to be the catalyst for that, but I like this stock. There's some unusual activity in it, so check it out. Okay, next one I want to bring up is Hood. Now, I'm sure a lot of you know Robinhood. Many of you probably trade on Robinhood. I do not trade on Robinhood. But there has been some rampant call buying the past couple days. Yesterday and the day before, the stock was up a lot, so I did not get in. Waited for a pullback and saw some buying in this one. We bought this one, unfortunately, a little bit early on in the day here. You can just scroll through and see all this volume trading. This is a meme, Reddit stock, whatever you want to call it. Now, unfortunately, we did get in a little early today. So we do have a nice big old loss in this one, but the options that I got expire in a couple weeks. I got the 65-75 call spread at the time. That was about at the money. As you can see here, the stock has declined significantly from when we bought those if they were at the money, because now they're pretty far out of the money. I would recommend, in my opinion, I did a spread on this one because the implied volatility here is so high, and if this implied volatility comes down, you will lose on this trade indefinitely, even if the stock moves in the direction that you will profit from the trade. So calls obviously profit if the stock goes up, but if the stock shoots higher and this implied volatility goes down, you are almost guaranteed to lose money on this trade because implied volatility is so important. I cannot stress that enough. So I did a spread on this one. I've lost money to implied volatility so many times. I've learned the hard way that doing a call spread, it limits your upside. But when the implied volatility comes crashing down and you do a spread, you're long one call, you're short another call. The call you're long, you are losing to implied volatility. The call you're short, you're gaining to implied volatility. So it's almost an even a gain to loss on the implied volatility. Now, obviously, it's not a one-to-one. Looks like we lose $4 to implied volatility here with this one, and with the short one, we gain about $3. So, it's a heck of a lot better losing $1 to a percent change in implied volatility versus buying this straight call and losing $4. Because if this thing goes down 86%, you're losing 86 times 4 instead of 86 times 1. And this thing has a long way to fall here. I think the implied volatility of the S&P is like 20 or 30%. Just to put into perspective how high this implied volatility is here. Now, this one is obviously a speculative trade here. This thing shot up to 85 the other day. Now, that was obviously extremely overvalued. I think it's still extremely overvalued. That's why I'm not going out and buying the stock here. I'm using the options to speculate here. So, thanks to everyone who's been subscribing. I really appreciate it. Make sure to keep the subscribing up. Make sure to like the video. If you enjoyed the content, make sure to leave a comment down below if you got any questions. Make sure to share this video with somebody who loves trading or who's trying to learn how to trade. We'll see you in the next one.